Hello. Today we're going to talk about LIBOR and the transition for non-bank lenders. And we have an expert with us here today, David Wagner. He's a senior advisor to Houlihan Lokey, and he's working with Houlihan Lokey on the transition from LIBOR to the new alternative rates. So David, maybe you give us a little bit of your background and explain to us how you got here.
Sure, be happy to. I'm a market practitioner for 30 years. I've spent much of my time in fixed income world, and in particular in a derivatives world, and then for a large bank in the US running their fixed income trading business, and I was on their management team. So in that process of being on their management team and deeply involved in the mechanics and fundamentals of their fixed income business, an opportunity came up in 2014 where the Fed was calling together 17 banks, and they were going to talk about an alternative to LIBOR, and they wanted everyone to represent on that panel and bring the weight of the organization with them. So I and another representative, there were two from each bank, total of 34, joined the ARC, and I brought with me then that sort of senior executive experience and broad understanding of how a bank looks at LIBOR from its trading business to its lending, and brought that to the ARC and stayed there for 4 years till 2018. And that was all the way through the time that SOFR was selected as an alternative. So my background, fixed income derivatives, and then LIBOR all the way through, and it'll actually be with the end of LIBOR as well.
Great. Well, we've had a couple different webinars on kind of the process and the twos and throws along here. But what we want to do is kind of get down to the nitty gritty, since some things are getting more formalized. But and talk about specifically SOFR, and how is SOFR different from LIBOR, and why is there problems around that, or why was that chosen?
Yes. Yeah, and a lot of people ask me, and I will tell you that one of my claims to fame now is that I was one of the 34 voters to SOFR. So yes, I voted for SOFR. Please don't send me your emails. But this is how I see the differences between the two. And it is the differences between these two indices that creates sort of all the anxiety and the problems and the challenges around this transformation. SOFR is a secured rate. It's the secured overnight funding rate, where LIBOR is an interbank rate. It's secured so that its rates are determined from treasury repo agreements collected every day. LIBOR, on the other hand, is unsecured. It's a rate set by experts at 11 a.m. in London. And curiously, LIBOR then is about US dollars which are offshore or outside of the Fed's jurisdiction around dollar markets. SOFR then is administered by the Federal Reserve, where LIBOR is administered by a private organization called the Intercontinental Exchange, and then regulated by the UK's FCA. SOFR has this characteristic that it is an overnight rate only. It's 1 day. There's no multiple tenors for the rates at this point. Where LIBOR has this complete set of tenors, 1 day, 1 month, 3 months, all the way out the line. There's a series of tenors that make it very useful for borrowers and lenders. SOFR is absolutely an IOSCO compliant rate. It has $1 trillion of daily observable transactions, and that's what made it so attractive when we went to select that as the appropriate rate to use. LIBOR currently, in some cases, is not IOSCO compliant because there's often insufficient transactions in certain tenors, and through the years, it's been accused of being subject to manipulation. SOFR has a market in instruments that can show its forward path, like futures and cleared OIS swaps, and as does LIBOR with the Eurodollar future and its cleared swaps. So you can see the places where they look the same, but at the same time, there are some real fundamental differences between the two. Both of the markets are totally visible now, and that's really what's kind of nice. For a long time, as we were talking about SOFR, you couldn't quite see it. Now, and this is a Bloomberg screen, it's a BTMM, and you can see that over on the far right-hand side of the screen are the LIBOR fixings. A little bit to the left of that, a couple of columns over, are the Eurodollar rates, and again, the Eurodollar is the contract, which references the LIBOR rate in the future. So these are the Eurodollar contracts that establish the swap market and the swap curve that we all use. And right alongside it, then, you can see that there are SOFR contracts. So there are now a fully traded market in exactly the same sort of dates and instruments that it takes to hedge in a SOFR environment as there is available in the Eurodollar environment. Two rates that I'll just point out on this, and this obviously was taken on a particular day, so it won't be appropriate today, but the LIBOR rate on this graph is, I think it shows about 26 basis points, where the SOFR rate, which is in the top left-hand side of the page, that rate is 7 basis points. So right off the bat, you see that there's a difference between those multiple tenors of LIBOR and the single rate, which is SOFR. So what that really means, and one of the really fundamental differences in the way that these two rates operate, is that tenors drive the payment mechanics, and it drives the borrower experience. So to the extent that you're a lender, a bilateral lender or a private credit lender, your borrowers are going to experience a change in the way they pay. And what I've heard from a lot of borrowers is that matters. It's something that fundamentally changes their mechanics and how they do their business. So SOFR will change that. There are, because it is an overnight rate and not a single rate, my example, let's use 90-day LIBOR for a second. In 90-day LIBOR, it's set at the beginning of the period, and it's paid at the end of the period, 90 days later. Very easy. You've got 90 days to get your money ready and to make your payment. With SOFR, it's observed on the first day, and the second day, and the third day, and the fourth day, all the way along the line. It's observed for 90 days, and then on the 90th day, you get your bill for how much the payment is. So from a borrower's perspective, it means that you've got a very short window to determine your cash flows, and it's an adjustment to the way that your payment mechanisms go. The markets, of course, have, and all of the bodies, and I'll mention the Loan Sales and Trading Association, ISDA for derivatives, the ARC, the Alternative Reference Rate Committee. All of these bodies have recognized that there's a fundamental difference here between these now and have suggested some alternatives. And actually, probably towards the end, I'll put up on the screen a series of references where you can go to look and find some of these things. But this I pulled directly out of some of the ARC's publications, and it talks about the mechanisms that are useful to make that overnight series of rates the same as, or at least useful enough, like 90-day LIBOR was. And if I just walk through them quickly, the plain approach is just to average SOFR over the period and pay it on the last day. But if you don't want to do that, or if that's mechanically difficult, you could do a payment delay. You could average it over the period and pay it a couple of days later. And that's the way the swap market works. It's typically paid T+2. The other mechanisms are things like lockouts or suspensions. In a lockout, rather than using 90 observations, you might use 85 or 87. And then you'll have a 3-day or a 5-day window to figure out how to get your cash up for your payment. There's also an approach which is a look back, where you take that same 90, maybe shift it back a few days. So there are different mechanics in the way that you can make that overnight string of payments look like your multi-day tenor rate, like LIBOR was. But it's something that has to be agreed between borrower and lender in both in new transactions and in the provisions for what happens when LIBOR goes away. So the ARC put together a nice graphic of the things that I just talked about with my fingers. And it's useful when you want to walk through, but you can see that payment dates shift, and walking through the mechanics of how that shifts is very, very informative for when you try to go and do those amendments. The one thing that I do want to talk about is a concept of economic equivalence. And the ARC, LSTA, ISDA, everybody knows that if SOFR is 7 basis points and LIBOR is 25 basis points, if you shift to SOFR, a borrower's happy, right? All of a sudden, they're paying less. And the lender is then unhappy because he's receiving less. So that difference, right, has to have some economic equivalence built into it. And there were a number of proposals discussed at the ARC, but the economic equivalence that's being, I'll say, roughly dealt with, and I'll talk about roughly in a minute, but being roughly dealt with is a method of observing what's going on in the past and applying it to the future. So the ISDA recommendation for derivatives, and LSTA will likely adopt something very similar, is to take 5 years of observations of the daily difference between 90-day LIBOR and overnight SOFR. So 5 years of those observations, take the single mean, and that will be the one number that gets added to SOFR for every contract going forward forever where LIBOR becomes SOFR. So when I say rough equivalence, it's rough because it's one number. It's not a basis curve. It's not something more complicated that tries to get to the right thing for every period. It's a single number that gets added. And recently, Bloomberg was selected as the provider of, first, the observing and calculating and providing that number. So the chart that you're looking at there is the spread adjustment, and Bloomberg's ticker for it is SUS003M. And this graphic is for a long period of time, and it's had to use some material because some data because SOFR didn't exist, but they put this together to give you an illustration. The axis runs from about 18 basis points to 27, and you can see that this 5-year look-back approach has generated an increasing spread of between 18 and 20 basis points. And the line at the end is so smooth because that's when we finally used good SOFR data for this calculation. But you can see that it is slowly increasing, but it's observable every day. So if LIBOR were to go away today, that number, which is approximately 26.1, would be the number you added to SOFR every day in the future. So when you look at all these things, you have to ask yourself, well, is SOFR that much like LIBOR that it'll work well, right? Will doing a single number really work? So this chart, also from Bloomberg, shows the 90-day LIBOR rate versus the overnight SOFR rate. And you can see that it's actually moved both ways at times. As you track the white line, which is LIBOR, you can see that at the beginning of the pandemic, in fact, the expert rate, which is LIBOR, fell before SOFR fell, and then went back up as SOFR precipitously, plummeted because of all of the cash that was moving into the short-term market. So there's actually been quite a bit of variability between those two rates. This graph, also from Bloomberg, shows that differential and a histogram of that differential, and you can see that the spread of differences in the histogram is predominantly in the middle, around 15, 18, 20 basis points, but has been as wide as 100 on the top end and minus 300 in an event last September. So where the spot difference is on the day LIBOR ceases may be very different from where the spread adjustment is. And understanding that condition may be in place will be important, again, in the conversation between borrowers and lenders. So that, in a nutshell, that's kind of the differences between SOFR and LIBOR and the places that they start to impact.
So, that gives some people comfort around using SOFR and the fact there'll be some adjustments and it'll take some time. And obviously we can't foretell that, but I think everybody's a little anxious and wants to know what's going to happen when LIBOR, stops, like the morning after. Who do you call? What happens next?
Yes, and that's so. I thought I asked myself, how could I display what happens when LIBOR goes away? Because LIBOR is like toast in the morning. It's like it's always there. You wake up and it's ready. Well, so I did this. I said LIBOR goes away, and your same screen looks like that. Suddenly, there's no LIBOR fixings, and essentially there's no Eurodollar contract. And to the extent that your markets are predicated on either of those two instruments, it's gone. Now, it sounds severe, and we're obviously preparing for that event, but that's what it's going to look like. And you're going to pick up the phone and you're going to, how do I establish payments now? How do I figure out how much I'm paying or receiving in all of my contracts, right, across derivatives and loans and cash instruments and everything else I have, deposits. So, but yes, that's what the problem looks like. The answer in the industry is encompassed in one word, and hopefully the word makes enough sense. It's fallback, and that fallback is the idea that on this day that LIBOR doesn't appear, your transactions have been prepared for it in advance. And they've all likely got some language in it that says, what do you do if you can't find LIBOR that day? And the concept has always been that LIBOR will be temporarily unavailable. And before this whole conversation about replacing LIBOR started, the idea that you couldn't find LIBOR for any period of time was sort of considered ridiculous. So all of the documents, or a large set of the documents that are out there, do not contemplate the permanent cessation of LIBOR, only its temporary unavailability. Now, that can start to have some confusion then in the way that that this process will happen the day that you wake up and there's no LIBOR. Loan agreements, and that's a lot of, I think the people who are listening today are looking at loan agreements that are in a lending environment. Well, lending at least has this ability to amend your documents, right? And it can be, it's a negotiation. It has people's interest at heart every time you open them up, but it has an ability to handle these kind of changes which were never contemplated. Securities, on the other hand, a lot of securities don't have the ability to do that. They may end up being the subject of litigation or actions of trustees, but loans have instructions. And the instructions that are typically in loan agreements say things like, and you can call your attorneys at Eversheds, and then they'll help you with what all your documents say. But they typically say things like, use the last LIBOR because they expect it to be temporary, or call some banks and get a rate, or use prime. And there could be other instructions that are in there, particular to the way that your loan works. But those are the kind of languages that typically show up. And those are all the languages that are for temporary unavailability. Problem with this temporary unavailability, if it becomes permanent, is that it could create a value transfer. Think about it for a second. If you end up with a document that says, well, if you can't find LIBOR, use prime. Well, prime is 275 basis points higher than LIBOR. Well, your lender's happy. They just got a big bump up in their coupon. Your borrower, not so much. So that's the kind of value transfer that'll happen when you simply go to the existing fallback language. And obviously, it's an unintended consequence that needs to be taken care of, particularly since we all know in advance that the cessation is virtually certain. So a lot of the documentation, at least before 2017, doesn't even have SOFR. That acronym didn't exist. And even between 2017 and today, SOFR is not enormously prevalent in much of the loan documentation that's out there. And for all documents that have no references to SOFR and that lack adequate fallback language, we sort of refer to them as legacy assets, things that'll be difficult to fix and are definitely going to create a value transfer. And along the line, there's going to be offensive and defensive strategies for dealing with that. But I'll just go through for a second that loans in particular, and this language or this box comes right out of one of the ARC documents for, I think, fallbacks out of bilateral business loans. And it says there's basically two ways to establish fallback in a new deal right now. You can do an amendment process, which doesn't prescribe a specific rate yet, but it streamlines the process of handling that disappearance of LIBOR, the cessation of LIBOR. The other way to do it, which is also an ARC and LSTA recommendation, is hardwired language. And it is what it sounds like. You're going to design exactly what happens. And the recommendation for the exact steps is here. So first thing you'll do is go to a term SOFR plus an adjustment. If the term you were using doesn't exist, you can use the next best term. If no term LIBORs exist, you can go to a compounded SOFR. And if that doesn't exist, then the lender has a right to select a rate. So in this way, you contemplate all outcomes and provide for everything that happens. And it could be quite likely that term SOFR, meaning some kind of an in advance 90-day rate, which uses the SOFR methodology, may not exist. The ARC would like to see it exist at that point, but today it doesn't exist, and there are no guarantees that it will exist. So it's quite likely that you may move down this waterfall on the day of cessation. One of the things that ARC is suggesting is that there was an ability to sort of return to the top of the waterfall if a term rate becomes available. These are details that you have to work through as you do the replacement language in each of your contracts, but the idea that you could return back to term SOFR if it becomes available is contemplated for or discussed in the markets. I would like to mention, though, there's this idea of, okay, I see hardwired fallback, amendment fallback. How do I know when I fall back? Like, what is the thing that actually makes me fall back? And that thing we refer to as a trigger. It sounds a little dramatic, but it's an event which is observable by a public body. And there are kind of two categories of this trigger. The first obvious one is the one I showed before. You wake up in the morning, LIBOR doesn't show up on the screen. Well, it's ceased. Or ICE no longer publishes, or there are a variety of things where LIBOR is not available, can't find it, you're not going to find it. That's the obvious cessation. There's another set of conditions around these triggers, and that set of conditions we call pre-cessation. And that's when a responsible governmental authority says something like, the LIBOR you see on the screen is no longer representative of the market. And that non-representativeness is cause for you to move to the replacement rate. And this pre-cessation absolutely could happen while LIBOR may actually still show up on the screen. This is a confusing condition, but all of the documents are defining and contemplating the concept of pre-cessation, so that the intent is that it happens uniformly across derivatives and loans, as an example, so people don't get caught out on one contract and not on the other. So fallback's present in all of your loan documents, and it's part of what will happen going forward. You've got to make sure that fallback is complete and comprehensive. Under legacy assets, these would be securities or other things which are much more difficult to change or to amend, and they'll have this largely unintended consequence of a value transfer. And when this happens, there are some other solutions that are being proposed by the ARC, and I'll describe them as regulate and legislate, but in the US, it may end up being litigate. So we've got regulate, legislate, and litigate are all potential outcomes for these legacy assets. It does seem that in inventorying the list of assets that are in your firm or in your shop, if you end up with these unfixable assets that could have a legacy problem, it's important to understand what they are, how they work, and get some priority on how to handle them. So legacy assets are one part of this fallback condition, but for lending in general, amendments and move through that amendment process, that's the way that things are going to fix that day you get the blank screen.
Well, for lenders, legislate, regulate, and litigate all sounds really uncertain. So I think that folks want to be out there doing whatever they can not to have those three items come into play with the loans that they've got. So what should lenders do now and kind of in preparation for the future?
Yes. And yeah, clearly the ARC, the LSTA, everybody is focused on that. And when you think about what could happen in the legal ecosystem, there could be an immediate huge demand in the legal system. So everyone wants to avoid that kind of a spike in that sort of activity. So the recommendations out of ARC, and ARC again it's an industry group. It's sponsored by the Fed, but it's an industry group, a broad set of participants. They've recommended a couple of things. We talked about this hardwired replacement first. So this is a little bit more detail on that language, but they've absolutely said hardwired replacement so that there's no confusion about where that loan document is going to go. This is essential. And in fact, they've in their best practice recommendations, they've said that new deals, new loans should have this hardwired benchmark replacement language embedded in contracts, in every new contract for loans beginning September 30th of this year. So this September 30th should have hardwired language according to the ARC's best practice guidelines.
Should we say that one more time? Should we say that one more time?
It's a big date, September 30th this year, which is we're still in advance of that date at the point that we talked about this, but it's impending, and I would say that there's a number of considerations that still have to be worked out around how that change is going to take place for everyone. But September 30th of this year it starts, and actually I'll show a timetable here because. These are the recommendations from the ARC. It's best practice timetable. So it's not regulation or legislation, but in the different categories categories of assets that are out there with fallback, that reference LIBOR. If I look at the second grouping, that's business loans. And the blue bar represents the amount of time until hardwired fallback has to be included. And if you look at the top, that date is September 30th. ARC's best practice also suggests that the vendors should be able to handle that as well at the same time that you implement it in documents. Sounds like a good idea. When your documents are, say, hardwired fallback, your vendors and systems should also be able to accommodate that hardwired fallback. Then there's this big gap that lasts for 9 or 10 months. And the red line is the line that says, on the day the red line starts, that's the day you no longer do a new deal with LIBOR. So ARC's best practice, in fact, isn't about LIBOR ceasing at the end of 2021. It's about LIBOR ceasing in the middle of 2021. So it's a little bit faster than we all kind of think when we think about the end of 2021. So, and the white space in the middle, I should have written a big word in there, and that word is amend. Every deal should be amended before that red line comes in, because essentially every deal is going to have, you want every deal in your book to have this consistent language so you know what's going to happen the day LIBOR goes away. And in fact, if you're really doing SOFR deals on July 1st of next year, there's no reason why you shouldn't see if you can't move those deals into SOFR, even during the amendment process. Right. Ultimately, it's this diagram's here so that you know there is inevitability, and everyone knows you can't do everything on the last day. So when you say, what are the solutions? The solution is to move to hardwired fallback. That's what the ARC suggests. There's still lots of time, as long as we all start that process, build our transition plans, understand exactly how to do it, hire our consultants and our attorneys and make sure everything works properly. But there are issues. Even the ARC's hardwired fallback leave some things to the drafters of the documents. And part of that is the mechanics that we talked about before. Well, exactly how do I want to do payments, look backs, arrears, advance? How do I really want that payment to work? In the process of doing this, you also have to remember that the SEC's out there inspecting asset managers. And there's a thought from the SEC that the non-bank lenders should have a similar sort of conduct risk perspective that bank lenders have. And so to the extent that there's asymmetry between the knowledge base or the sophistication between your lender and your borrower, conduct risk is an important consideration. And conduct risk really starts with communication. So how do you communicate with your borrowers around how and why these changes are happening? And in fact, nothing prevents you from going to SOFR right now. But even if you're going to call them up and say, hey, we want to change our deal so that we have this guaranteed hardwired mechanism to replace LIBOR, that's a conversation that'll have details they'll have to work out, and they'll have spreads that'll also have to be contemplated by everyone. So those are the things lenders have to, can and start doing right now along the timetable that the ARC has suggested.
Right, yeah, and you mentioned the SEC. There's a fair bit of interpretive guidance out there. The SEC's also put some OC releases out there saying that you need to be disclosing how this is going to affect your business, what you're doing to prepare for it, and what what impact it could have. So there's and the staff, I believe, is out there also doing for various exams to try and figure out what people are doing. So there's definitely a fair bit of activity right now, and you're starting to see some of that creep into disclosures and that type of thing, appropriately so. So maybe yes, we can drill down just one more level and talk a little bit about kind of what types of things that you should be doing as far as negotiating the terms kind of going forward, and just giving people a little bit of a flavor of that before we go.
Yeah, no, and that's good. And a little of this is part of it's just the forward thinking about how this negotiation process works. And Cynthia, you're absolutely right. The conduct risks are present on the minds of the regulators and the inspectors, and a lot of it has to do with spread adjustment process, right? And how you deal with that change, that's the dollars and cents difference. So spread is going to be part of the amendment process. The ARC is trying to create concepts of equivalent value, but it's still a negotiation around all of the terms that are in that contract. So it isn't just a single rate that can be plugged in easily. You've got to work through all of the conditions. So it starts with just as a lender knowing what your fallback says, right? Where's that going to go, even if I don't change anything? So you should definitely know what your fallback says in the first place. But then you want to look at all of the pieces that are in your loan. And I'd like to say that there's this sort of hidden negotiation piece that's available in loans right now. This is a graphic from the LSTA, and they show that this is the percentage of loans that have floors in it and the average rate of the floor. So their numbers show me that in the last 5 years, the average floor has been 1%. And although a lot of loans didn't have it for 2018 and 2019, a lot of loans have it now. In fact, there's, I think, something like 95% of new loans have a floor in it. So remember, I mentioned at the opening that I'm a derivatives guy. So as soon as you say floor, I get very excited, and I whip out my option calculator, and I start talking about floors and options and value. So I thought about this a little bit. Floors are mostly intrinsic value. At this point, there's almost no option value. So this graph talks about the forward rates, meaning the predicted 90-day rates that are embedded in the interest rate curve 6 months ago at the top, and I think August 1st at the bottom. And then there's that black line, which is the 1% floor. So 6 months ago, when lenders were embedding 1% floors, well, not only did it turn out they were pretty smart, but that floor was still sort of an option. It wasn't really in the money at any point. And that's the way that you characterize an option. 6 months later, after the Fed has done all of its activities in the repo market, well, you're way in the money. So way in the money in option language is intrinsic value. That floor already has value to the lender. And in a certain way, when you think about it, it's that little bit extra value that you had hoped would protect you, and now it's actually there, and it is protecting you. Borrowers, I'm certain, on the other hand, regret having put that 1% floor in now that rates are so low. So it could easily be part of this conversation. And one of the things that we are suggesting that you consider is that now that this is so in the money, you could take this set of forwards, and if you look at that 5-year rate, even at the 5-year rate, it's 40 basis points is the projected forward rate. Between here and the next 5 years, it doesn't exceed 40 basis points. So with a 1% floor and a 40 basis point forward, there are 60 basis points there, which at this point are highly certain cash flows. So you could, in your negotiation with the borrower, eliminate the floor altogether and suggest, and I'll just use these numbers as an example, that you move the spread instead to 60 or maybe 55 basis points. So you give a little bit back and eliminate the floor, because the discussion of where is the floor versus LIBOR versus where was it versus LIBOR versus where is it against SOFR, and how does that spread adjustment work, is all going to get mixed up together in the value of this floor. So if you eliminate the floor and negotiate taking the value of the floor and adding it instead to spread, I'll suggest that lenders are very adequately protected because the Fed has implicitly already given you the same floor at zero. I mean, the Fed's come out and said, negative interest rates are not on our list. Right? Now, obviously, but they've certainly said not on our list of tools. So you've got a floor. You don't need it from the borrower anymore. So you have a floor rate, and now in this process of negotiation, you have a tool that could allow you to give something up, because in many ways, the borrowers are looking at, and just looking at this, I had a list here. Yeah, the borrowers in the last bullet are looking at the fact that they probably feel like they're the only one doing the changing, right? You came to them and said, no term rates, your payment mechanics are different, right? Break funding looks different, and there's this spread adjustment, and they're going, wait a second, I get nothing, and I make all the changes. By thinking about that floor, and particularly now that its value is highly certain and not an option, I think that's one way of negotiating with your borrowers. So it's an example of the fact that as you think through the amendment process, there's a number of things that are on the table to create a better deal for both of you without just talking about a single number like spread. So that's, this is just a list of resources that I use to prepare some of these comments. Most of them are from the ARC, a little bit from the LSTA, and a little bit from my firm as well, where we have some white papers. So I like your questions, Cynthia, because they are the right questions for, particularly for lenders in this private credit bilateral market. There are real considerations with the way this transition is going to work.
Great. Well, thank you very much. I think this was very enlightening. And we've been trying to provide kind of a progression on the information that's available. And as you can tell, it's coming up and developing all the time. So we will be back with you again when as we move through this this process over the course of the next couple years, I think I would say. But anyway, and also just remember your SEC filings, and if nothing else, risk factors and that type of thing need to be taking it into account at this point, kind of what we've been discussing. So David, I want to say thank you, and we'll be back with everyone soon. Thanks.
Terrific. Thank you, Cynthia.